So welcome to the subject matter of FAC. FAC 1601. Right, my pen was not behaving, so let me just adjust that. All right, so now this is the new curriculum beginning 2026. Right. Some of the concepts that are covered in the Learning Unit 1 are very much related to the previous learning unit. However, there has been some changes, some noticeable changes. And then this FAC, starting from 2026, is a new curriculum. And being a new curriculum, it's going to be interesting as to know how they're going to examine the concepts. The concepts are not entirely new, but most of the concepts that are being examined now used to be examined in the subject FAC 2601. Right. So they've been pushed down to FAC 1601. And so that's actually very brilliant of the lecturers, because most of the concepts that were being studied at FAC 1601 before were not very much linked to your studies later on. Like you would study partnerships, students would study close corporations, but going forward, then you wouldn't study close corporations or partnerships anymore. So although the accounting concepts or principles will not change, but the application to partnerships and close corporations was not quite relevant to your studies going forward. So this is, I believe, is a very innovative change. So welcome to the Financial Accounting Reporting Module, FAC 1601. Now, in this Learning Unit 1, we're going to focus on the conceptual framework. I believe that if you studied FAC 1502 at UNISA, you were introduced to the conceptual framework. Right? In Learning Unit 1, I think, unless if they also, but they haven't changed this year. In the previous years, they haven't changed. Right? So some of the stuff was introduced to you. So the reason why I'm doing a recording for this is just to transform the presentation of the content from written text to audiovisual, right? Because sometimes it helps if instead, let's say you're traveling, you would like to study, you can't take your phone to read, or your laptop, or maybe a hard copy if you print it. It's much convenient to just sit and listen, right? Somebody does the explaining. So basically the purpose of this recording for Learning Unit 1 is to transform the material from a written text to an audio visual where you can listen and see a demonstration. But going forward, there will be other learning units where we actually need to demonstrate principles and explain. But for the purpose of Learning Unit 1, it's just a transformation from one format to another. Right, so let's start by talking about the conceptual framework. So there's a new conceptual framework which was introduced in 2018. So we used to have one for 1989, which was revised in 2010, and now we have a 2018 conceptual framework, the revised conceptual framework. So it's not very much different from the 2010 one, but the lecturers will be very much interested in the actual wording of the 2018 Conceptual Framework. So when you study, please make sure you use the 2018 Conceptual Framework terminology, technical definitions of concepts. Brilliant. So I will take you through some of the things you guys should know already, and I'm sure you really do know. Right. So then the other thing is, I think I have a list of questions for the conceptual framework, right? Multiple choice questions, which could be very helpful. Sorry. So if you're in a class, remember you can always, we will provide that to you. But if you are not in class, then you can try perhaps on the internet. Then there is a lot of questions that you can there's a lot of questions that you can also learn and practice with. So let's talk of a general purpose financial or reporting. You know, a financial or report is a summary of the activities of an entity, right? So the purpose of financial reporting is broad. Sometimes you have a general purpose where you produce your annual financial statements and then you produce them to whoever would love to use them. Like whoever it could be. So in general, that's why it's a general purpose financial reporting. Because you are reporting on the activities of your operations for whatever period to whoever. It's like your annual financial statements, you don't say you're preparing this for this individual. But sometimes you have specific purpose financial reports where somebody specifically requests you to present a financial report of something. So they will tell you specifically what they want, and then you will have to present exactly that, right? So that's a specific. So we can discuss a specific financial reporting, specific purpose financial reporting, because we don't know who would have asked that. So we can only discuss general purpose, which is governed by general standards, like this is what it should look like. So the objective of general purpose financial reporting is to provide financial information about the reporting entity. And that information should be useful. And now you need to know the users. So it's the existing and potential investors. This is your standard questions you would get in the examination. Who are the users of financial? What is the purpose of general purpose financial reporting? What is the objective, rather, of general purpose financial reporting? And so there's a lot of things. There's a lot of users that you need to identify. So this is the investors, lenders, and creditors in making decisions relating to providing resources to the entity, right? So you normally get this in this concept examined. It's examined in a true or false question. Which of the following statements is true? And then they will play around with, they will remove this and put that, right. So you have to pay attention to the words that they underlined here. The underlined words, they have to be there, all right? And this general purpose financial reporting is established by the conceptual framework. Right? So the conceptual framework doesn't just focus on the actual, on the standards governing the financial statements. It also touches on the objectives of a financial reporting. Right. And remember, because we're focusing on reporting to the users of financial statements, whose monies, whose investments will be affected, right, by the entity's operations. So Previously, financial statements were the major focus, but now, although they remain an integral part of financial reporting, your financial statements are not the most important. The objective is now broader than it was in the past, in the sense that you have to do your financial statements, but there's a lot more you have to do reporting on. So you have to do a report on sustainability. Are you using water responsibly? Are you using renewable resources? Are you using diesel? What are you doing to the community, your community responsibility? Uh, how do you generate value for various stakeholders? So the reporting accompanying financial reports is more extensive than just telling people how much profit you made. Right? You have to talk about a lot of other things. Your work in the community, your social, your work to improve the community, to improve the environment, to improve the workers. So the objective of financial reporting is now much broader, right, than just financial reporting. So that's some of the things you need to remember. So we talk of a general purpose report. Uh, so the purpose of a general purpose report is to it's useful to, now this is very important, primary users in making decisions relating to providing resources to the entity, right? So the primary users are the investors and the lenders, right? So the primary users of financial statements, and these are identified by the conceptual framework, all right? Right. So you understand that the primary users here are going to be those guys who were identified here: investors, creditors, and lenders, right? So we can talk of existing and potential investors, existing and potential creditors, existing and potential lenders. Now, why is that they are the singled out? Why don't we talk of shareholders? Well, because the shareholders can actually request the financial statements any day, you know. Uh, but if we talk of potential investors, well, the shareholders will be potential investors. But if we talk of the existing, I wanted to talk of the management, for example. Uh, we can always access that. But if you talk of your shareholders, they don't know how the company is being run on a day-to-day basis. So they rely on these reports to assess the company's ability to generate future cash flows. So using that information, they can make these decisions, uh, whether to buy, sell, or hold the equity and debt instruments. Right. So they will decide what makes the best benefit for them, whether they will provide loans and other forms of credit, and how they are going to vote. But some of them have a right to vote. So they have to vote to influence the management's decisions, which affect the use of the entity's economic resources. They will decide based on what the company is doing. Okay, so as you can see, these guys are protecting their investment, right? So when they make those decisions, they are looking at the returns, like how much can I get from here? And when they look at a return, it's you invest something in a company, and what are you going to get out of it? So that's a return, right? What's going to come your way if you invest? Uh, so the expectations about the returns are based on, so we mean the investors uh, are going to make an assessment of how much am I going to receive it? How much am I going to receive? right? When and what's the likelihood that um, they will have the money, you know? Because somebody says to you, okay, give me 100,000 rand, I'll be able to pay you 10,000 every month. So you'll be receiving 10,000, right? That's the amount every month. But what are the chances you will get it? So the uncertainty of future net cash flows to the entity. Because then the guy can come and say, but I don't have it. And they promised you a certain amount at a certain time. But now, how sure are you? So when the investors make an assessment um, about expectations, they are focusing on the amount, timing, and uncertainty of net future cash flows. Right. Um, um, they also make an assessment of um, management's ability to manage the economic resources. So they're looking at the profits that were made, the statement of financial position, and everything to see how good are you at managing the company. So there's a lot of things that they can look at, right? Right. So for them to do that, they will need to know how much um, is the economic resources of the entity. That is your assets and your equity and liabilities, which are the claims against the entity and changes in these resources and claims. So basically, you need to look at your assets and your equity and your liabilities, right? In short, and how effective was the management in satisfying those responsibilities. So in other words, we basically very much interested in the financial position of the entity. Okay. Then what else should we focus on? Right. So we need the financial position. We need the financial performance. That is uh, so we need the financial position, financial performance. And the financial performance of an entity is about profitability, income, and expenses. And the income and expenses are going to affect uh, the all right, the financial performance, which also affects the financial position. So you need to know the investors are interested in the financial position, financial performance, uh, right? So let me see what we go to next. Now, so we're talking now of accrual accounting, right? So financial performance is reflected by the accrual system. So an accrual system of accounting depicts the effects of um, transactions when they occur, even if there is no cash receipts or payments made. So accrual accounting, some of the things that we taught you in FAC 1502. So that's accrual accounting, where we said you can pay, let's say there's rent income that you're renting out some space, and then every month somebody's supposed to pay 5,000, right then. But in the last month, the guy couldn't pay, all right? And then, but your rent income, the income that you report, is going to be 60,000, because that's the income you have been entitled to. All right. Whether you actually received it or not is not the is not the concern of accrual accounting. Accrual accounting is you report income, you report income when you have the right to receive it, or when you have earned the income. Um, when you've earned the income. And you need to remember that there's a difference between earning and receiving. You might have earned something, but you haven't received it yet. So accrual accounting says if you have earned income, you need to disclose that income in the statement of financial performance. You don't focus on receiving. If you focus on how much was received, then it's no longer accrual accounting. It's called cash accounting. With the cash accounting, we don't care as long as we received the amount, right? Then with expenses, we look at whether we have an obligation to pay, right? So basically, it was actually incurred. So the expense should have been incurred, right? Uh, and that's accrual accounting. So to incur means it doesn't matter whether we paid or not. So we aren't looking at whether payment was made. To incur means you have an obligation to pay. To incur means you have enjoyed and you're now supposed to pay. So if somebody uses electricity and they don't pay, but since you used, you have an obligation to pay. Whether you actually paid or not isn't the point. So the total amount of expenses represents the total amounts of expenses that you incurred and not necessarily which you paid. So accrual accounting, uh, we will have things like your accrued expenses. Those expenses, we did these things in FAC 1502 when we were talking about adjustments at year end. So if accrued expenses are those expenses which haven't been paid yet. But because we accrued them, we have to, they are part of the expenses disclosed. And then the unpaid portion becomes a current liability, right? Then we also have accrued income, the income that we earned, which we haven't received yet. Then we have income received in advance, the income that is received but is for future periods. Then we can also have a prepaid asset, a prepaid expense rather. I can say a prepaid expense, or a prepayment, whereby excuse me, whereby we have paid rent for the next 2 months. We haven't stayed in the house, in the office for the next 2 months, but we paid in advance, right? Then we have a prepaid expense. So that's the concept of accrual accounting, because if we use cash accounting, then there's no accrued expenses, accrued income. We just record what we received. But if we use accrual accounting, then there's going to be a mismatch between how much was actually received and how much was actually earned, or how much are we entitled to. So once there's a mismatch, then the mismatch portion goes to the statement of financial position. So I think they gave us an example. On 1 March 2016, a company purchased inventory on credit. The company has a policy of settling creditors after 60 days. According to the accrual basis of accounting, the company must account for the purchase transaction on 1 March when it occurred, and not when the actual cash flow occurs. In other words, when settling the creditor 60 days later. So what it means is we purchased the inventory on credit. We now have an obligation to pay. So it means we have incurred an expense. If we incur an expense, we also have an obligation to pay generally, right? And so when we incur the expense, the amount incurred is the total amount that you include as an expense. Whether it's paid or not is not important for accrual accounting. But for cash accounting, then you need to right? Then you need to apply cash basis. So accrual accounting is applied to your statement of financial position, your income statement, statement of profit or loss, your statement of changes in equity. But your cash accounting, we'll see later in our studies, it's applied to, what is this thing called? Cash flow statements, right? Where we focus on cash receipts and cash payments for the periods. Right, so briefly we pass by who are the users of financial reports. So these are the primary users. You need to know them because they're going to ask you in the examination, in a test, in a multiple choice test, who are the primary users of financial statements? Or they will have a way of asking you. So it could be existing or potential investors, existing or potential lenders, existing or potential creditors. The other users of financial information, like your government, your tax authorities, can always have access to the information through other channels, right? So remember, the general purpose financial reports are intended for the primary users of financial statements. So please remember that. Right. So we're going to talk now about financial statements and their reporting entity. So your examiners want to talk about, the lecturers want to talk a lot about what is a reporting entity. And they want to distinguish between a legal entity and a reporting entity. Right. So in talking of financial statements, we are focused on the assets, liabilities, and equity, as well income and expenses. Remember, basically, these are the things that we report. So your assets, liabilities, equity, statement of financial position, and your income and expenses, statement of financial performance. If you combine them, you get a statement of changes in equity. If you now look at actually how much cash is being paid for all these operations, then you look at your cash flow statement. So it's just playing around with those 5 elements of financial statements. Do you still remember them? They are the 5 elements of financial statements: your assets, your liabilities, equity, income, and expenses. And do you remember which ones affect statement of financial position, affect financial performance? Do you remember which ones affect financial position? So those are some of the things, little things that you need to remember. So a reporting entity refers to an entity that is required or chooses to prepare financial statements. The entity, so a reporting entity is the entity that is preparing the financial statements. Remember here, this is not necessarily a legal entity. It could be a portion of an entity or comprise more than one entity. Right, like I said to you earlier, this is a question that the examiners love asking. They love asking, what is a reporting entity? And they will give you A, it's a legal entity, B, it's this and that. But a reporting entity is whoever is reporting, preparing financial statements. If we can identify that unit as a unit and we focus on their financial statements, that unit, whoever they are, is a reporting entity. It doesn't have to be registered. It could be a division. It could be anything. Yeah. It could be a group of companies that are coming together and that are working together. All right. So please pay attention to the difference between a reporting entity and a legal entity. Right? This has to do with the registration, and this has to do with just who is reporting, who is reporting. And the reporting period doesn't have to be 1 year. It's any period, any specific period that the reporting entity chooses. So some reporting entities could to report 3 months or quarterly financial statements. 3 months. Some biannual or half yearly financial statements. Some annually. Some monthly. So the reporting period it's not necessarily 12 months. It's it depends on the period that is being reported. And remember, sometimes for reporting, we might need comparative information so that the information is useful. So I could report for, right, January to March, January, February, March. So January to March 2026. Then I might also need to provide comparative information for the same period, January to March 2025. Right. So you can really compare how the changes have been within this quarter, the first quarter of the year. So just for comparison purposes. Okay. Right. And remember also this perspective is important, that financial statements are focused on the reporting entity as a whole. Right. So this applies particularly in companies that are joined together. Right. So it's not from the perspective of a group or anybody else. Right. So just know that when we do reporting, we just focus on the reporting entity. And one of the underlying assumptions is the going concern assumption, right? Where we expect the entity to continue to operate for the foreseeable future. So this is one of the lecturer's favorite questions in the examination, right? When the lecturers are going to ask you about what is the going concern assumption, and they try to test you with various ways, right? And one of the ways is that they just play around with words. Like they might say the entity is a going concern and will continue to operate for the foreseeable past. And you will say, you will probably, and it's possible a student might just look and say, well, yeah, that is the correct. We'll continue to operate for the foreseeable. In your mind, you have the word future, but they just said past. So they will just swap around a word, exchange one word for another. So you have to be so you don't have you have to be very careful. So what it means is we believe that the financial statements are prepared on the basis of going concern. If not, then a different basis would have to be used, and that would have to be reported in the accounting policy of the entity. That going concern is not applicable because the company is going to wind up business in 3 months or in 2 years. So we don't see the company going forward. Right. So you will remember the qualitative characteristics of useful information. And we have, of those, we have the fundamental. So that's very important. So the fundamental, and we have the fundamental and the enhancing qualitative characteristics, right? So for information to be useful, firstly, it has to be relevant, right? And faithfully represented. So for information, financial information rather, to be useful, it has to be relevant and faithfully represented. Okay. So it has to be both relevant and faithfully represented. So then that information will be considered useful. So for information to be useful, financial information, it has to satisfy the fundamental qualitative characteristics which is a relevance and faithful representation. But then once if information is faithful and um, faithfully represented, or just faithful and relevant, then we have enhancing qualitative characteristics, especially if we can compare that information with if the information is comparable, we can verify the information. It's delivered to us on time, and it's understandable in a format that is understandable. Right. So a relevant, what is a relevant information? Information is relevant if it makes a difference in the decisions of the users. In other words, relevance means if you include it, it makes a difference. If you exclude it, it makes a difference. So if you include some information, right, people will decide differently. If you exclude that information, people will decide differently. So means that information is relevant to decision making, right? So financial information can make a difference in decisions if it has predictive value or confirmatory value, right? So predictive value is it can help you to form a position of the entity into the future, like, oh, given this information in the future, things could end up like that. So that's predictive value. Or confirmatory value is things that you always thought uh, are like this in this company. The company is not doing well. Things are going to be that. And then there's financial information, and it confirms exactly um, what you were expecting. So that will be the idea of a predictive value and a confirmatory value, right? Right. So what said relevant information, it's about it will impact the decisions of the users of financial statements, right? And what else do we talk about? Right. So that was for relevant. So they will ask you around that. Um, so predictive value allows users to forecast future outcomes. And confirmatory value provides feedback to correct prior expectations. So you had expectations and now you have the information. So that's predictive value and confirmatory value. Right. But then we also speak of materiality. Right. So materiality is a concept that is related to relevance because um, um, information could be relevant, but doesn't make a difference then due to materiality. So information is material. If its omission or misstatement could influence the decisions of users based on this information. Right? So the relevance is also affected by materiality in the sense that materiality has to do with the nature or magnitude of the items to which the information exists. For example, we say here, this is very important. So please just underline that materiality is an entity specific aspect. So that means that what is material to one entity is not material to another entity, right? Um, so depending on the nature and magnitude. So I give you an example of a nature. So something could be very small, but it's shocking. Like for example, it could be the amount of money involved is 10,000, right? But you tried to bribe it's a bribe, and let's say a company is making billions of rands, sells 40 billion rand revenue, that's revenue. Cost of sales, 30 billion, gross profit, 10 billion. But we just see that you wanted to bribe one of the officials, maybe from a department, to give you a license, and then you end up in. So the amount is just 10,000, right? So the amount is very small, but the nature of the information is very important. Or it could be that's the magnitude where you made a loss of 1 billion when you were selling, like you had an ask you had a branch in Limpopo, and you decide to sell it away and you make a loss of 1 billion. So it's so huge. So it's material. But then material is relative. Materiality is relative. So when we say materiality is relative, we mean that what might material to one is not material to another. For example, if you are not employed and you lost 100 rand in your pocket, and so that will affect you. You will be so stressed, isn't it? But some big guy who is making millions, and they lose that 100 rand that was in the pocket, they don't even care. So materiality is entity specific, depends on the company, right? And many other things. Brilliant. So remember that relevant information has predictive value and confirmatory value. And the relevance of information is affected by materiality. Right? And materiality itself is also affected by the nature and magnitude. Right? So you will enjoy that. So if you're not going to join us in our classes, I would advise you to just look for conceptual framework multiple questions on the internet. Then you can play around with them, right? So that will help you a lot. Okay, so we have an example of materiality here. So this is an exposure draft. An exposure draft is a discussion that accountants have before they agree on how to what standard to apply. So the accountants are going to discuss globally, all right, and they will decide how to what to agree on. But before they agree on anything, they have an exposure draft, which they will be talking about. So exposure draft is the information that you will be talking about. Like, let's talk about this thing. It looks like this and this. So here is an exposure draft. I think it has to do with materiality. So a misclassification of an asset as equipment, right? That should have been classified as plant may not be material because it does not affect the classification in the statement of financial position. It's still PPE. So PPE, you have plant, property, and equipment, right? So something was supposed to be equipment, but now something was supposed to be plant, but now you extended put it under equipment. However, it's still under PPE. So the actual class isn't very important. Right. But a misclassification of the same amount might be material if it changed the classification of an asset from plant or equipment to inventory. So that's a totally different category. And so that it doesn't follow, it might. Okay. And so that's the nature, I think. And so that's the nature of the error. This one is the nature. Then an error of 10,000 in the amount of uncollectible receivables. That's your credit losses written off. It's more likely to be material if the total amount is of receivables 100,000. So because that represents 10%, right? Than if the receivables are 1 million, because then what you are writing off, the error is just 1%. So that's small. It's like even if a lecturer is marking your work and they make a mistake that costs you 10%, So that's significant. You would want to agree, right? You obviously you could fail. Yeah. You could really fail and say, well, I failed because there was an error in the marking of my work. But if the lecturer or the examiner marks your work and just makes a mistake by 1%, you wouldn't cry and say that made a huge difference. So but it depends on what that 1% did. So if this 1% stopped you from getting a scholarship, then that's very material. Right? But if you then get 58% instead of 59%, then that's nothing. But if you got 74 instead of 75, and you didn't get that distinction, which would qualify you for something, then it becomes material. So materiality is an issue of who is involved and what's their story. In other words, the nature and significance. So that was a relevancy. Then we have faithful representation. So remember, under relevancy, we spoke of materiality, we spoke of confirmatory and predictive value. Now, faithful representation has three qualities, right? So a faithful representation is complete. So you need to know that. It's neutral and is free from error, right? So, and this is a question that they love so much, that a faithful representation is affected by the level of measurement and certainty. So they will just ask you and say in multiple choice, which of the following is affected by measurement uncertainty? And they'll give you its faithful representation, its relevance, its materiality, it's the conceptual, it's anything. So you need to take this mark because they ask it a lot. Previously, they've asked it, which of the following is affected by the level of measurement uncertainty? Then it's going to be your faithful representation. When you go to third level, then we talk of more other uncertainties that also affect relevancy. But I think we're just introducing here. All right. So what you need to know is that faithful representation has three characteristics: complete, neutral, and free from error. Right. So now let's talk about what that means. So faithful representation has to do with substance over form. Now, what does substance over form mean? A faithful representation provides information about the substance of an economic phenomenon and its economic reality instead of merely providing information about its legal form. So I will try to explain for you or to you what that means, the concept of substance over form. So I have to think of an example where where people I'm sorry, but it's a practical thing, so I'm going to just use it. Where people are married, right? So there's people are married, there's husband and wife. So what happens sometimes is then so there's a husband and wife. Now this is what this happens in life, and then they are married, right? But in actual fact, they are not, because um, let's say the husband is a president and or some high-ranking official, and you or the wife or husband, and you do it to retain your status. So you remain married to retain your status as a high-ranking official to gain the respect of the people. A lot of people do that. They say, don't divorce, even if you are not staying together. So you remain married, but in actual fact, you are no longer married, but you keep it like that for the sake of status. So the substance is you are no longer actually, in effect, you are not married. But you keep the marriage together to give an appearance, right? Appearance, right? So in financial or reporting, you report the substance, what actually is the case, not what the appearance is, the form that you are keeping, right? Because if you report the form that you are keeping, then that's not a faithful representation. That's not the true state of affairs. That's not the economic reality. So tell people the reality, the substance of the reality, not their appearance, right? So that's the concept of being faithful representation. So if you tell people you are married, so you appear together at functions and stuff, and after that, each one goes to their own home, right? So you give an appearance, but in actual fact, and so that's not. So the picture you give to the people is not a faithful picture. So when you do provide financial information, right, you focus on the substance of an economic transaction, the economic reality, not the appearance. So that's the concept of substance over form. And that concept of substance over form, it's part of faithfulness, being honest, faithful representation. What you tell people is the true state of affairs on the ground, right? Right. So some of the things that we focus on, um, right, is completeness. Yeah. Tell people the complete story. Don't leave some portions because they are ugly. So if you are going to be faithful, tell everyone the complete story, right? So information included in the financial reports should be complete, right? And it should include all the information that a user would need to be able to understand. So this could include descriptions and explanations. So that might mean that you need to put in additional information to explain that during the year, this is what happened, beyond just putting in figures. Like your PPE has 100,000, now you have to talk what happened, explain, right? So here we have an example of information that is not complete. Like where an entity is involved in a lawsuit, is being sued, um, and there's a chance, you see that there's a chance that they might end up losing the case, or even if they're going to win the case. But as long as they are being sued, please, whether you think you will lose or win, just report that. Don't leave it out. So there's a proper way to do that, right? All right. Okay. So that's complete information, because the users of the financial statements would like to know what's going on with you. So that's completeness. Completeness means all the information that should have been included has been included, and if necessary, please provide descriptions and explanations. Right? Remember, this is faithful representation. Then neutrality. Don't take sides. A neutral presentation is one that is without bias when selecting or presenting financial information. Right? So in exercising neutrality, we exercise prudence. So prudence is you look into the future and what is likely going to happen. So prudence is the exercise of caution when making judgments under conditions of uncertainty, right? So prudence does not allow for overstatement of or understatement of assets, liabilities, income, or expenses. Now, what I would say about prudence, because there's what is called the prudence concept. So under the prudence concept, the key focus is don't overstate income, don't overstate assets. Then do not understate expenses, do not understate liabilities. Right? So when you look at the prudence concept, for example, that is the concept that allows us to write off credit losses because we don't really know who will pay, but we must estimate so that it doesn't come as a shock when it actually does happen. So we need to exercise caution because there's a chance some people are not going to pay. So, and we end up having overstated assets to say our assets, our trade receivables are so much, but there's a chance some are not going to pay, and we cannot categorize them um, as trade receivables. So that idea of caution. So basically, bias is neutrality is information should be presented without bias, right? Okay. Especially when there is an option to make estimates, especially when we are going to make estimates. Our estimates should be as balanced as possible. Then, besides being complete and neutral, faithful information also has to be free from error. Now, this does not imply that the information is absolutely accurate. Right? Like everything with commas, comma point 00 has to be perfectly accurate. You can have rounding off where, for example, an entity has assets worth 140,567,383. They want and 50 cents. They won't really have to disclose them as that. They might just say 114,600. You know, maybe or maybe 114, 114, 567, like that. That's not totally accurate, right? So it doesn't have to be absolutely everything. No, not really. So if you look at the financial statements of companies, they have a lot of zeros, rounding off, cutting off. It cannot be absolutely accurate. But however, it does should imply that the description of the event is free from error, and the process followed to provide the reported information has been selected and applied without error. Right? So that's freedom from error means the process that has been followed means that the information is without error. Like we didn't forget anything or we didn't use the wrong amounts, right? And then enhancement is when information is comparable, verifiable, timely, and understandable. So this is the enhancing qualitative characteristics. So this is very interesting because I'm used to teaching these things at third level. So I'm actually seeing them here at first level, and so I find it uh, very interesting. Very, very interesting. All right. So, and I also find it interesting, but at the same time, I don't know how they're going to examine that, right? Because uh, this is the first time, right? But for our level, yeah. Right. So there is a process that is followed for information to be useful. But sometimes there's a conflict between relevance and faithful representation. Uh, so there's a trade-off. Sometimes there's a trade-off. Uh, so if so sometimes they say here, if you can have a faithful representation, and does not necessarily mean result in useful information. So if something is considered relevant, then the view taken is that the item does not really need to be disclosed if something is not considered relevant, regardless of whether it can be faithfully represented. However, if an event or transaction is relevant to the financial statements, it would be important to present the information faithfully. So the overriding principle here is relevance. It has to be relevant first. And then after being relevant, it has to be that which is relevant has to be faithfully represented. Right? So first step if you want, is to first step that is followed is to identify a transaction. So that's what we will refer to as an economic phenomenon. Um, and then in that transaction, you look for the information that you might give to the information that you might give to the users, which is most relevant. And of that information which is most relevant, you need to present that information faithfully, right? So once this process has been followed, the process ends and the relevant information is presented faithfully in the financial report. This is very interesting because I normally teach that at third level, but well, what a change. So this means is if you identify an aspect that is relevant, then you need to be able to measure that, to faithfully represent that. If you can't, then there's no need for you to represent it because you cannot, there's no need for you to disclose it because you cannot faithfully represent it. So it stops being useful. So this is the process that is followed. You identify a phenomenon or a transaction, then you decide, so which of these should be followed? Right. So there is a scenario there. I don't know what that is in the discussion forum, but what I would do is if you're in my class, I'm going to formulate my own scenario because we have these scenarios from third level. So we have a lot of them that we're going to work with. Right. For the purposes of those who are not going to join class, I will just give you, so where is it? So I think this is the scenario, right? So let me just go through it. So the objective is to apply the principles of whatever. So so they say compose your post. An entity invests in AI um, that detects traffic transgressions and issues tickets, right? Then the entity decided that the most relevant information about this is its fair value, right? We will see why. However, there's no observable market to determine the fair value. Therefore, they would need to estimate it. There are no similar AI or market valuations available. Thus, an estimation will have to be made using other data. There's also a high degree of measurement uncertainty. The cost of the AI is 16 million rand. So, right. The issue here is that there is an economic phenomenon, right, which is worthy reporting. And that economic phenomenon is definitely relevant, right? Right, it's relevant, but what information should you disclose about that? So there's a lot of ways you can use historical cost. You can use fair value. Um, so if you decide to use fair value and you think that is what is relevant to the users, uh, um, then you need to make sure that you can apply that faithful, should be represented faithfully. Then if you can't, because of a high degree of measurement uncertainty, you have to go back again to relevance and say, okay, because the property which we chose, the information which we chose cannot be measured faithfully. Is there another information which we can choose for which there is a measurement, a low degree, for which there is not a high degree of measurement uncertainty? So you can go back to say, okay, instead of fair value, can we use historical cost? Then historical cost, if historical cost will be relevant, then you go back and say, let's use historical cost. Now that's the new information. And based on that new information, you now look at measurement uncertainty. And there's no measurement uncertainty because you know the cost is definitely 16. So there's no measurement uncertainty. Now, because you have gone back, so the first starting point was, so right? So the first starting point here is you identify an economic phenomenon, right? And you decide that it's relevant, it's relevant. And being relevant, the information that you would like to display to the users at the fair value. Then you come to faithful representation, and you know that this will violate the principle of faithful representation. In other words, there's a high degree of measurement and certainty. And then you have to go back to relevance and say, can we have other relevant information about that economic phenomenon? And then this time you say, okay, we could use a historical cost if that is going to be relevant. And if that is also relevant, then now can we faithfully represent that? And you see, this does not violate the faithful representation because it does not have a high degree of measurement and certainty. Because actually, it has measurement certainty because you know for a sure the historical cost was 16 million. You don't have to estimate it. So now, if it's irrelevant, then you're going to use that. All right. So you keep on doing that until you find the relevant aspect of the information which can be faithfully represented. So it's a what is this thing called? It's a process. It's a cycle that can do up and down until you find that aspect which is relevant and which can be faithfully represented. Right. All right. So I hope you enjoyed the adjustment of the process until we can achieve both relevance and faithful representation. Right. So we're not going to worry about comparability, verifiability, timeliness, and understandability because those four are the enhancing uh, qualitative characteristics. Right. So prudence is when we are neutral, no bias. Should not be biased. And we must exercise caution. So prudence is the exercise of caution when there is uncertainty. So prudence does not allow for the overstatement of assets and income or the understatement of liabilities or the expenses. So measurement uncertainty has to do with freedom from error, right? So information doesn't have to be completely accurate, right? So if there is a bit of measurement uncertainty, doesn't mean that the information is no longer useful. But in some cases, the most irrelevant information may have such a high level of measurement uncertainty that that will reduce its usefulness, so that we might have to settle for something that is slightly less relevant, so that we can that is subject to lower measurement uncertainty, so that we can satisfy both requirements. So we have spoken about that. I hope you guys enjoyed that. Uh, Now we talk of the constraint on useful financial reporting. Right? So we have to find a right balance. Because you might want information to be very accurate, but then that comes with a cost. And the costs of preparing the financial information could exceed the benefits to be derived from the supply of the information. Then the information will not be reported even though it might meet the characteristics of useful information. It's useful, but the benefits are exceeded by the cost. So that's the cost constraint on useful financial reporting. Right, so what else do we need to talk about? Right now, we need to talk about the definition of the various elements. So don't worry about this at all. Why should you worry? Don't even look at that. I don't think that they would say, try to tell me what the old definition is, because we're just going to focus on the new definition based on the 2018 conceptual framework. So a present economic resource, an asset is is an economic resource. So that's one. Controlled by the entity, that's the second aspect. As a result of past events, that's the third aspect. Now, an economic resource is also defined as a right that has the potential to produce economic benefits. So it's a standard definition that you must know. You don't have to paraphrase that. You should be able to reproduce it as it is. And you need to reproduce it as it is. And also be able to identify whether something qualifies as an asset or not. So you need to identify whether it's an economic resource, in other words, whether there is any right that has the potential to produce economic benefits, and whether there is also the element of control, and identify that past event which triggers the right to get economic benefits or the right to control. Right. So let's talk of the right to produce, the right that has the potential to produce economic benefits. So a right refers to entitlement, right? You are entitled. Right. So an economic resource is not an object you can identify, but it's a rights that lead to those benefits. So the rights could include, so I want to make sure that because this is the same material that you will study at that level, but it's not important that is just pure of the conceptual frame. So these rights would include the right to receive cash or another asset. Right. Rights could be established by contract legislation. Right? So that's what I want you to know. You can have a right as a result of a contract or as a result of a law. Right. Right. So legal ownership of a physical object may give rise to several rights, such as the right to use, right to sell, or right to use as security, to pledge as security, and other undefined rights. So the right that I want you to think about is the right to receive cash or another asset, or exchange a liability on favorable terms. But for our level in first year, a right, the right to receive cash or another asset, in like trade receivables, is perfect. So just know that. Then the potential to produce economic benefits. And then if we have a right, it should have a potential to produce economic benefits. Right. And the potential to produce economic benefits does not have to be certain, probable, or even likely, as long as it's there, right? That potential, as long as it's there, as long as there is a potential to produce economic benefits from that right. So economic benefits could be increased cash flows or increased cash inflows or reduced cash outflows. Right. So we're going to pay less or we're going to receive more. And then control. So when you look for control, you are looking for the ability to direct how a resource is used, right? And as you have that ability to direct how a resource is used, then you will obtain the economic benefits that may flow from that resource. Right. Right. So that's what I want. You need to know that you need to be able to direct a resource and obtain the benefits, as well as prevent other parties from directing the use or enjoying the benefits that may flow from it. So if you have control, you are able to direct the use, obtain the benefits, stop others from directing the use, and stop others from enjoying the benefits. And for you to be able to do that, you do not necessarily need to own the asset, so that you can control it. You need to have the right to use it to restrict others, even though you don't own that. So let's look at an example of a definition of an asset, right? So you have UNISA rents vacant space from the landlord for 25,000 per month for the next 12 months. Starting 1 January. It uses the space for its off-campus for whatever. This space is fitted with the gym equipment, and UNISA has their own staff who operate the gym. So this can give you an idea of control. And set its gym times based on the availability. So that is control. Then the landlord requires a rental deposit equal to 1 month's rent. Required, UNISA is accounted for the 50,000 rand as an asset. However, you must prove this in the form of a discussion. So we are not talking of the recognition criteria here, just talking about whether it's an asset or not. The recognition criteria is the information has to be useful. So we're talking of whether this is relevant, whether this is faithfully represented, but that's fine, don't talk about that. So we're going to talk about is a right. So we're going to talk about a right to produce economic benefits, a right that has the potential to produce economic benefits, and that's the present economic resource. So the first thing when you deal with whether something qualifies as an element, meets the definition of an element, you need to reproduce that definition. So an asset is a present economic resource controlled by the asset as a result, controlled by the entity, as a result of past events. Okay. So if you look here, we're going to identify those aspects. Remember, a present economic resource has to do with a right. So do they have a right? Yeah, they have a right to occupy the space. So they have, and then they can give that right to their staff. So they have a right. And the resource that is controlled by the entity. The entity has control if they have the ability to direct the use of that and obtain the benefits. So UNISA can, because it decides on what equipment to install and what time it will use it. And it can restrict the use to its employees, right? Then there is a rental agreement and the payment of rent. Therefore, UNISA has the ability to enforce the legal rights. So there is a contract that gives us the legal right, and then we have the legal right to enforce that. So ability to enforce a right is also part of control. Then the resource is a result of past event. There was a contract signed and payment of cash. So therefore, this meets the definition of an asset. So, okay. So if I can give you a summary, right? We need, all right, no, instead of giving you a summary, can I just take you through this discussion forum? UNISA invested in government bonds, investment property, and inventory. Apply and discuss if this meets the definition of an asset. Right, so, the present economic resource, it refers to a right which has a potential to produce benefits, potential, a right that is potential to produce economic benefits. So what is the right here that is granted to? So if you invest in bonds and something like that, you have a right to ownership. And there is a potential benefit in the form of cash flows from these bonds which can come, which can appreciate in time. And they can be also, I think, investment property and inventory. Right. So we can sell them so we can get cash, or we can wait, or we can get, I don't know what we get here, rent. There we can get, so whatever, depending on what what the asset is. Right. So there is a right there is a right. And then in terms of control, this will be registered in the UNISA's name, right? If it is an investment property, government bond, it's going to be registered in UNISA's name, and no one else has the ability to benefit from those bonds except UNISA, right? So because they are registered in UNISA's name, and that right is enforceable. Let's say if somebody wants to take over the investment property, then they can enforce their right of ownership, and they can prevent other people from benefiting from the same. Then the past event is the investment, which could be a result of payment and a contract. Right. Then for a liability, you need to pay attention to a present obligation. And then the present obligation to transfer an economic resource as a result of past events. Then an obligation is a duty or responsibility that the entity has no practical ability to avoid. So if an entity can avoid a particular duty or responsibility, then that cannot be identified as as a liability. So how do we get an obligation? How do we get to have an obligation? Or it could be through a contract or legislation or similar means that are legally enforceable by the party to whom they are owed. Right. So obligations can also arise from an entity's customary practices, published policies, or specific statements. You make a statement, then you can be held to that. If the entity has no practical ability to avoid fulfilling that that responsibility or duty. So that is called a constructive obligation. A constructive obligation is it's not it's something that you have been doing. You have shown by you've I think you have shown a sign, right? Or by the way you behave, right? So it's like, let's say at home, there is right. Let's say there's a construction site where people are working. And then at the construction site, there's a guy who arrives early in the morning with magwinya and fat cooks every morning. And he probably comes and makes tea there every morning. So people, the workers come in at the construction site every morning, and they know that they saw when they come home, when they leave home, their homes, right? They leave home, they know that they will eat there at work, right? I'm giving an example of a constructive obligation. So this guy is always providing magwinya and tea there, and the guys can have breakfast there. But they never have signed a contract. But because of the behavior of this guy, people have come to build their lives around that this guy will be there. So they want a breakfast. Then on the day that this guy doesn't come, the people will be very angry, like he broke a contract, because he really did break a contract. So that contract is called a constructive obligation, because you made people believe so, right? And they build their lives around that. Now you are withdrawn. So in some cases, if you're a company, that can be legally enforced to say, no, no, you don't have to do that. So that would be a constructive obligation, right? But we also need to consider that you have no practical ability to avoid taking that action, right? So with the example I gave you wasn't about the practical ability to avoid fulfilling the obligation. It was just about an idea of how a constructive obligation can arise. So we need to see which obligation is it. So an entity can have an obligation, a legal obligation or a contractual obligation, which is obviously legal. Both contract and legislation is a legal obligation. So what is the promise and why? Then the transfer of an economic resource. It could be the payment of cash, or the giving up of an asset, or the exchange of a liability at an unfavorable um, um, rate. And then we also need, as a result of past events. Remember, this is a present obligation as a result of past events. So what examiners do when they examine you, they will say past obligation as a result of present events. They swap the words around, and you will not remember exactly what it was, right? So in this case, no, so there's no case here. It's just a theoretical explanation. So we have a present obligation as a result of past events if the entity has already obtained the economic benefits or has taken some action. And as a consequence, the entity will now have to transfer an economic resource. The entity has done something which triggers the transfer of an economic resource. So here we're going to touch this quickly. So based on that old example, UNISA has not paid rent for December, right? Okay. So there's a present obligation. There's a duty to pay that rent. And there's no practical ability to avoid this duty since it's legally enforceable through a rental agreement, right? Then this requires a transfer of economic resources in the form of cash. So that's straightforward. And it's a result of past events. We have already enjoyed that, and there's also a contract, right? So that meets the definition of a liability. So equity is never a problem. It's just straightforward. Equity, it could be ordinary shares and preference shares. For our level, we say preference shares could be equity, but ordinary shares are also equity. Then income is an increase in assets or decrease in liabilities And that will result in an increase in equity. But then we have to exclude some increases in equity which could arise from contributions from the holders of equity. So I think that's rather straightforward. Um, then the expenses is the opposite. It's a decrease in assets like depreciation, credit losses, or increases in liabilities, which result in decreases in equity, other than those relating to distributors of orders of equity claims. So if you look at a liability or, no, my apologies. If you look at the income and an expense, right? You see that when we recognize an asset or liability, right, we might as well recognize income and expense because income and expense are related to assets. So when an asset increases, there's a good chance that an income is also, we debit an asset, credit income. So for us to recognize income or expense, it's based on whether we are recognizing an asset or liability as well. So when something meets the definition of an asset or liability, then it will also follow that it can meet it can meet the definition of an income or expense. Because if it meets the definition of a liability, then it means that that could represent an increase in a liability, which could be an expense. Right? Then the recognition and de-recognition. So I'm not sure here if they will ask you to, in a written examination, they might ask you to identify an asset or liability because they gave us examples of that. But I'm not sure if they will talk about income and expenses. But in class, I'm going to give you examples that we're going to cover together, right? And I'll take you through all assets, liabilities, income, and expenses in the exercise that I will give to you. Right, so recognition, what do they want? I'm just having a look at what it is. What is it? Okay, yeah. So recognition is when you record something in the financial um, um, financial statements, accounting records. So recognition is the process, and they want you to know this definition. So the process, they say, what do they say? Because normally it was multiple choice, so they'll say uh, the process of what is recognition? Yeah, they'll say what is recognition, and then they give a lot of answers there. You need to just remember it's the process of capturing for inclusion in the financial statements an item that meets the definition of an asset, liability, or one of those five elements. So recognition means the first step in recognition is to meet the definition of one of those five elements. When you meet the definition, then you can consider something for recognition. So recognition is appropriate if it results in useful information that is relevant about the and faithfully represented, right? So that's recognition. So the recognition criteria looks at the usefulness of financial information of the information that is being um, disclosed, right? So something can meet the definition of an element, whether it's an asset, liability, or whatever, right? It can meet the definition, but it may not meet the recognition criteria, and therefore it will not be recognized as an asset. All right, then it won't be recognized as an asset. So to be recognized as an asset or liability or income or expense, it um, it should be relevant. So for the recognition criteria, relevance refers to uh, So there must be a law. Sorry, where the recognition of an item results in an irrelevant information may be affected by low probability of flow of economic benefits. So this is called outcome uncertainty. All right, there is a chance. All right, and existence uncertainty. Like, does the thing really exist? How do we satisfy ourselves that the thing really exists? So if there's a contract, then there's no longer existence uncertainty because we know there's a contract. Then faithful representation is going to be affected by measurement uncertainty, recognition inconsistency, and accounting mismatch. And how are we going to present and disclose that? So outcome uncertainty or the low probability of a flow or existence uncertainty. Does the thing really exist? And measurement uncertainty. So these two fall under relevance. And these three fall as a concern that falls under faithful representation. How are we going to measure the amount? And if we measure the amount this way, are we going to have consistency? So there could be accounting mismatch. Don't worry about what an accounting mismatch is. You won't be able to understand these things until sometimes you do your CTA or you do your honors. Then you might understand what is a recognition ecosystem when you have learned a lot of things, right? So right. So when it comes to measurement uncertainty has to do with estimates. When we cannot directly observe the amount or value of something, and then we have to estimate. For example, the trade receivables we have might be 100,000, but we know that some people are not going to pay us. So we have to estimate how much. So that's the measurement uncertainty. And it's going to be, we cannot observe directly. We have no way of knowing. So we have to make an estimate. And what is that estimate be? So we're going to have, so eventually our trade receivables will contain a measurement uncertainty. Right? But we must then use reasonable estimates. Right? But in some case, even though we can try to use reasonable estimates, they can be so, the level of uncertainty in measurement can be so high that we begin to question whether the estimate would provide a faithful representation, right? Right, because anything could happen, right? Like I gave you an example of 100,000, which is owed by customers. So anything could happen. It could be 50,000. Like there's a customer who is in another country, and maybe they are, or the economy is not doing well, so we can write off 50,000 or write off 75. So the range of possible outcomes is exceptionally wide, and the probability of each outcome is difficult to estimate. Right. So this is theory, so don't worry too much about the theory because when you have to do multiple choice questions, you can always refer until you are good. But they tend to be very fair. They don't go into depth, right? So they tend to be very fair, like asking you which of the following is a concern for a faithful representation. So they give this, they give that, they give something else, then they include presentation and disclosure. So you we will have to remember that, oh, under faithful representation, this is where we find it. So next, we have a trade-off between relevance and faithful representation. So I've already explained to you how that works. You have an amount that you think this is very relevant, correct? And you realize, but you cannot faithfully represent it. Then you go back again to the next most relevant um, item of information to present, and but then now you realize you actually have uh, faithful representation of that next most relevant information, right? So there is always going to be a trade-off, right? Right. So I have here an example um, of land. Right. So let's take a land. The user may want to use fair value, which is the most relevant. Fair value is the market value of the land, the price that you can sell the land for. So that represents the value of the asset. Because remember, for land, you don't use land, you hold land. You never use land, right? You hold land. When I say you don't use land, I mean you don't finish. If you're using land, you don't finish land. So it remains there. So the only estimate is if you would sell it, how much do you get? Right. So the fair value is the market value because land, you will leave it there. So you can only get the maximum benefit out by selling. But then you will not show there's a lot of measurement uncertainty because maybe there aren't other land transactions happening. Um, right. And so as a result, fair value is not going to be a faithful representation. Then the cost of the land, which you bought it for, may be less relevant, but it is more faithful. And then we have to say this is acceptable, and we can use that. Um, then we also have this concept of recognition inconsistency. It is important to consider whether related assets and liabilities are recognized. If they are not, then the recognition may create a recognition inconsistency or an accounting mismatch. Like an example of an accounting mismatch is where an entity obtained a loan to acquire an asset. Both the asset and the loan should be recognized. If you recognize one and not the other, then that could result in an accounting mismatch. Right. Um, so what are we talking about here? Did I jump something? Or trade-offs. We're talking of trade-offs, right? And then the other trade-off is that if you recognize an asset or liability, they always needs explanatory information. They will be needed. And normally we recognize income and expenses at the same time, which is called the matching of costs. But this is not a requirement of the conceptual framework. And then in terms of the cost constraint, we always consider whether the benefits of information. So that is also a trade-off between the cost benefit of the cost benefit of the acquisition of information and its use. Right. Right. So we are being told to compose a post. So you guys, if you want, you will compose the post. But if you're in my class, and you can if you enjoy that, if you have time, it's enjoyable, but it's not really necessary. All right, it's not very necessary. Let me just see here what's happening. We must apply the recognition criteria. In other words, can we get relevant information? Will it be uh, right? So let's talk about the rent of the gymnasium, and let's talk of whether we can recognize that. So what is the first case? So it's an asset, right, that is being rented out. All right. Then is the information is relevant? What is the most relevant information that we need to uh, we cannot estimate the future value of the gene, right? Because the what is that thing called? The most relevant information is the future value of that gene space of the render of the benefit. If we can get the future value of the benefit of the gene render, but we can't, right? Because we can't measure that. So if we can say the fair value of the future benefit is the most relevant, then we come to faithful representation and say it has a high level of measurement uncertainty, then we can't, right? Right. But then we come to say, okay, what about if we just present that at a cost, at its cost? Then at its cost, we see that there is no outcome uncertainty, right? Because there's a contract that is already signed, and there's no what? There's outcome uncertainty. What is the other uncertainty about relevance again? Uh, this was the outcome uncertainty. That was the low probability of cash flows because we already made a payment. And the other uncertainty is this is outcome, then the existence uncertainty. We don't have a problem with the existence uncertainty because there is a contract that is signed. So that contract actually does exist, right? And then we come to faithful representation and we talk about measurement uncertainty. So there is no measurement uncertainty because we are using the cost and we actually have the cost. We paid the 50,000. So this can be recognized on the basis of the recognition criteria, right? Then derecognition, if something doesn't meet the requirements, the definition of an asset or liability. So there's going to be a derecognition in that regard. Right, then we come to the aspects of measurement, and I'm going just to give remember we've been talking about measurement and uncertainty, but we can use a range of categories of measurement that we can use, right? Or measurement basis rather. So there's a range of measurement basis that we can use. For example, we can use historical cost or current value, right? So there could be a lot of other methods that fall under each of these. But whatever method we use, when selecting a measurement basis, so you used to be examined on this paragraph in first year, FAC 1502, right? If you remember. So it used to be very confusing because then it's lengthy explanations and you can't pick up what's wrong. So when we measure when we're selecting a measurement basis, it is important to consider the nature of the information, right? That the measurement basis will produce, okay. As well as the relevance in terms of the confirmatory or predictive value of the information, which makes the information relevant. So the information must be relevant. So when we look at the confirmatory or predictive value, we are looking at the importance of the information. How is it going to help the users? And it has to be relevant. It says to make any difference in the decision making of the user. It must be represented faithfully. And if possible, those enhancing qualitative characteristics have to be there as well. Right. So when we do a measurement of whatever, especially of an asset and liability, then we consider the measurement in the initial measurement and subsequent measurement. So the initial measurement is when we record it for the first time in the financial records. Then subsequent measurement is over time, how are we going to measure it? For example, we could have an asset like machinery. Initial measurement will be at cost according to the standards. Then subsequent measurement will be at cost minus accumulated depreciation, which is the carrying amount. So this will be your subsequent measurement. This will be your initial measurement, right? Then we come to, we come to one measurement basis called the historical cost. So basically, historical cost is the original cost on the date of acquisition or creating an asset. So historical cost of a liability is the same thing on the date that we incur the liability. What is its value, right? So historical cost, remember, it's going to be the cost. And for an asset, it's plus transaction costs. So we'll cover those things when we go to Learning Unit 3 and Learning Unit 2, where we deal with inventory and PPE, because then you will see how transaction costs are going to be included. And for liabilities, we minus the transaction costs. So, okay. So a historical cost of an asset is updated over time to depict. So sometimes you have an asset, you record it at historical cost, but then the historical cost will change over time, right? So it might be consumption, like depreciation, or payments received that extinguish the asset, like it might be trade receivables, your debtors, and then the debtors are paying. So when they pay, there's a payment received that extinguish the asset. So if the asset was a promised future payment, then there's also impairment. Like for our level, I would say impairment is a damage. Like if an asset is damaged, then you can't use it. Then that's impairment. Then if there's any accrual of interest, then that has to be adjusted as well. Right, so the same applies to the historical cost of a liability. It might be fulfilled, so it has to be amortized. Or then it has interest accruing that has to be also included. Brilliant. So that's basically the concept. Now we go to, well, you need to know that historical cost is the most common basis. But then we can also use current value. So there's a lot of current values that can be used. Fair value, that is the market price. If you're going to go to the market to sell. So if it is an asset, you're going to sell an asset. Or if it is a liability, then you can't sell a liability. You can exchange a liability. You can get someone to take their liability and you pay them. Right? So there are transactions like that. When you go to that level, we will talk about fair value measurement under IFRS 13. So you must enjoy these things, especially if you have the desire to be to do your CTA and be a chartered accountant. So these are the things you'll be playing around. So that is a build-up of what you expect. Then value in use is for assets, and it's also called fulfillment value is used for liabilities. So value in use or fulfillment value is about the cash flows that will be generated by an asset, or the future cash flows that will be required to be paid for a liability. Right? So you know that in year one, we're going to receive so much. You estimate. So there's an estimation that in year one, next year, right, 2027 we receive so much, 2028 we receive so much. Then you get the present value to say, we're going to be using this machine for 5 years. Year one, we get X. Year two, we get X. Year three, we get X. Year four, we get X revenue. Year five, we get X, or cash flows. So the cash flows that will be generated by this machine is You add up everything and you bring it to its present value. That's the value in use. So you want to look at, if I use this asset, right, how much value is it going to bring me? So that's the value in use. But if you have a liability, then you are not going to say how much value is it going to give me, but how much value is it going to take away from me. So it's more like, in the year one, you will pay cash flows of this. In year two, you pay so much. Year three, you pay so much. So the fulfillment value of that is going to be its present value. So this will reflect what you expect to pay, right? Right. All right. So value in use. This is, I think this, yeah, has to go. Has to go up. Has to go up, right? Because this is part. This is fair value. And then these two together apply to this, reflects entity specific. Because value in use is entity specific. Fair value is market based. So fair value, you look at, what are the market participants, the buyers and sellers, what do they think of our asset? But value in use is what you think of your own asset. So it's entity specific. Everyone will have what they think about the asset. But if you go to the market will have its own ideas. Then current cost, you think, I have a machine that I bought in 2020, but if I go to the market currently, how much will I pay? So you pay, how much are you going to pay to acquire an equivalent asset, right? Or to, or how much are you going to be, how much is it to, how much is it to, how much can you receive to take on an equivalent liability? So it's more like currently, if you would go to the market for a similar something. Right. So that's fair value. So this is the definition of fair value. So I think here, this fair value, they wanted to put it here. Remember, it's still new, so they have to be editing and aligning it. Right. So fair value, it's about what you think the other users in the market think. So if you want to exit, it's called an exit value, because you no longer want to hold the asset. You want to exit out of the asset or liability. So what's the price related with you exiting ownership of the asset or ownership of the liability? So it's an exit value. You go to the market and the market determines that. Right. Why are they talking a lot of things here, which actually, because the fact that transaction costs are excluded in determining fair value, that's correct. But why are they including it? So in the determination of fair value, transaction costs are excluded. So you have the market price minus transport costs, right? But not transaction costs like your taxes, taxation. What are some of the transaction costs? Whatever they are. So value in use. So it's like I showed you, it's about cash flow. It's an exit value as well, because you exit through use. You use it until you, um, and it reflects the entity specific current expectations. Remember, because everyone would think, well, how much is this asset gonna help me, right? So measures may differ for identical assets in different entities, because everyone will think, well, for me, it will give me this, it will give me that, right? Then fulfillment value is the same concept, except that you will be paying um, for, you'll be paying for the liability. Then current cost is, if you would go uh, right? So current cost, you are thinking into cost of an equivalent asset at the measurement date or on the reporting date. Uh, Basically, how much would you pay for an equivalent asset? Obviously, an asset always includes transaction costs. So it's an entry value because you are bringing the asset in, right? It's an entry value. The same applies for here. That's also an entry value. Then cash flow based measurement techniques. So you have to estimate how much revenue you're going to get and how much costs you get related to that particular asset or liability. Then you get your cash flow, right? How much, basically, how much cash inflows are you going to get against how much cash outflows, right? Right. So so I'm not going to focus on anything here. Uh, right. And then you need to know these factors to consider in selecting a measurement basis. So one of the most important things, the nature of the information that the measurement basis will produce. I think we covered this. And as a result, you have a lot of factors that will have to be um, considered. And then the relative importance of each factor will depend on the facts and circumstances. Then the information needs of the users of financial statements. What do they need most? Right. So I think this is everything. So for relevance, if the users of financial statements will need relevant information, um, then you have to consider the variability of the cash flows and the sensitivity to other market factors or other risks. Right. No, let me look exactly. Uh, right. So remember, we have historical cost versus current value. Historical cost is more certain because you know exactly what happened. But current value has to do with estimating cash flow. So you look at the estimation, the variability of the cash flows. But if you estimate cash flows, there are factors that affect those cash flows. So you need also to look at the sensitivity of those values to other factors. Um, so let me look here, contribution to future cash flows. Um, right, yeah, because we need to consider whether cash flows are produced directly or indirectly in combination with other economic resources. So if you have an asset that produces cash flows together with others, then you have a combined cash flow. You can't just attribute that cash flow to just one asset. Then for faithful representation, we will need to use a measurement basis. Uh, um, that provides relevant information, right? But if the measurement basis that provides relevant information has too high measurement uncertainty, we might have to consider a different measurement basis that gives us a more acceptable uh, estimate. Right. So that measurement of equity, you guys know that assets minus liabilities will give you your equity, right? So that's your asset is also your net asset. No, not your asset. Your equity is also your net asset value, right? Or it's also referred to as the net worth. Okay, so what else should I tell you here? And I don't want a presentation disclosure. That's nothing important. Um, right, I think that is very important because it talks about classification, right? Classification is when you sort assets, liabilities based on shared characteristics for presentation and disclosure. So when you classify the similar asset together, offsetting assets and liabilities, you can obscure relevant information, right? So offsetting is not recommended. All right. It's not a recommended. Elements of financial statements that share characteristics should be displayed separately, together, but without offsetting. They should be displayed. They should be disclosed together without offsetting, right? So offsetting occurs where an entity recognizes and measures both an asset and a liability in separate units of account, but groups them in a single net amount in the statement of financial position. Right. So I want to give you an example of offsetting and what is offsetting, what offsetting looks like. So when you offset, you say you owe a certain someone 100 million, and that certain someone owes you 80 million. Right. And then you owe someone this, and you are owed this. So you have to pay 100 million to person X, but person X also has to pay you 100. So offsetting is when you say you 100 minus 80, so which means that you just have to pay this guy 20 million rand, right? So you owe person X 20 million rand because you have offset your asset against your liability. This is what they're saying. They don't want that because in actual fact, you are owing 100 million rand. So you must say current liability, 100 million rand, or liability, and then a current receivable, 80 million rand. Because what can bring you down is this liability more than the asset. The benefits that the asset brings might be overweighed by the negative that the liability brings. So basically, the users of financial statements should see the true state of affairs without offsetting. That's why they say here. That's why the information says it can obscure relevant information, reduce comparability. Right? So people don't understand the true picture. Right? So you need to avoid offsetting. It's not recommended. But there are cases where offsetting may be required or may be done. Right? So we're done here. We're done here. Do I say offsetting? And then we have aggregation. Aggregation is when you combine things together. It could be assets, liabilities, right? So you could say in your statement of financial position, you should say PPE is 800,000. But in PPE, you have aggregated the land, right? The machinery, the equipment, motor vehicles, furniture. Then you have to show the more detailed information in the notes to say the PPE note. Then you present that PPE note. So in this level, this module, we're going to do the PPE. We're going to enjoy that. We're going to show you how to do that particular note. So aggregation is sometimes allowed when you going to break down the details later on. So this wasn't really much of a teaching from my side. I don't know if somebody thinks it's a teaching. It's just a transformation of information from text to audio. That's basically what I did. From text to audio and video, right? Because you could just have read it. But sometimes as a tutor, I need to do this to transform it for you. Because if you find it comfortable to read, then please do read. But if you would find it comfortable to just listen and do both, then it works. But remember that this topic, apart from the definition of assets and liabilities, right? Apart from the definition of an asset and liability, you you shouldn't expect a written response. It's mostly multiple choice questions. And for multiple choice questions, I said you can consult your internet. So just go there and say multiple choice questions about the conceptual framework. Then they will give you the very nice, because I once did that, I think some few years ago, just to add to the questions that I have for my students in my class. You just go there and say multiple choice questions for, and they all multiple choice questions for the conceptual framework. And they can actually give you questions where you can try to answer, and then they give you, afterwards you can submit, then they give you the your score and explanations. Right. We look forward to learning unit 2, which learning unit 2 was also from FAC1601 second level, but it's moved back, and it's a very enjoyable topic, so we'll enjoy that together.